Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26-year business. It's midday, Thursday, April 23rd, 2015, and the title of today's audio blog is A Record 8 Pages of Horrible Headlines Crammed into One Audio Blog. One day I'll be able to look back at this, the most mentally stressful period of my life, and both laugh at those that tried to ruin it and beat my chest with pride for having endured the worst punishment they could deliver. As I sit here Thursday morning, nearly a week into the worst bronchial episode I've had since college, I can't help but believe the strain of 13 years of cartel machinations are the root of my sickness, and more specifically, the 4 years since the powers that be, in 2011, reached their cumulative point of no return, at which point they switched from an as-needed manipulation scheme to one of 24/7 operation, encompassing not only relentless manipulation of financial markets, but economic data and the financial media itself. Regarding the latter, their incentives, of course, have traditionally been best served with a half-full glass. However, never since the Great Depression have they dealt with such a starkly empty container, and even in my wildest nightmares, I couldn't have conceived that the entire scope of previously respected financial institutions, from Reuters and Bloomberg to even the New York Times and Wall Street Journal, could so blatantly and pathetically forsake their mission statements in lieu of Goebbels-esque propaganda. Last night, amidst a 3 a.m. coughing fit, I all but scripted several pages of today's audio blog in my mind, and it's a shame Apple hasn't yet invented a telepathic dictaphone. I'm sure I'll recall most of it, but first, a very large handful of other topics to discuss, given the incredible 8 pages of horrible headlines that have accumulated since writing yesterday's article, and counting. First and foremost, I absolutely must soliloquize about yet another fantastic piece of research discovered by GATA's army of gold manipulation researchers. After all, both I and Bill Holter started out writing for GATA more than a decade ago, as now for free, and thus our writings, as well as David Scheckman's, are heavily influenced not by the mere premise of precious metals price suppression, but the heavily proven facts that such research has borne out over the past 15 years. Let alone, in my specific case, the decade plus of exhaustive research of the cartel's day-to-day machinations, as discussed in hundreds of separate articles, and the 7 manipulation primers I wrote in 2011 and 2012. To wit, last night's GATA publication regarding the discovery of, as always, public documents from 1981, in which the then president of the Bank of International Settlements, Yeli Zylstra, discussed exactly what we all know to be true. Speaking at IMF headquarters, what a shock, just a year past the terrifying global inflation scare that clearly took the powers that be by surprise, as depicted by gold's parabolic January 1980 surge to $875 an ounce, he recommended to a group of central bank heads the following gem of an oxymoron, i.e., to regulate the gold price in the free market. Next, he stated, I feel it is necessary for us within the Group of 10 and Switzerland to consider ways to regulate the price of gold, admittedly within fairly broad limits, so as to create conditions permitting gold sales and purchases between central banks as an instrument for a more rational management and deployment of their reserves. But that's just Jacks for starters, as GATA's fearless leader Bill Murphy would say. No, the real meat of the discussion comes next, when in plain layman's language he clearly discusses the dangers of another gold price spike, and thus how a new strategy must be concocted to prevent it from happening again. And bear in mind, listeners, that this is just 13 years after the previous price suppression effort, the infamous London gold pool, miserably and spectacularly failed, after just 7 years of overt existence. This is why it couldn't be more obvious that Zylstra is referring to a new covert means of suppressing the gold price per these statements. On the occasion of the IMF's annual meeting in 1979, this was brought up, but regrettably, insufficient agreement could be reached to make even a modest start with regulating the gold price in the free market. It is my conviction that relatively small-scale interventions, though not forestalling the subsequent explosion in the gold price, would at least have reduced it to more manageable proportions. Now that the turbulent emotion seems to have quieted down, we would be wise to reflect anew and without prejudice on these subjects. Fast forward to 2005, when such a covert scheme had clearly been in place for as long as a decade, if not more. In fact, Dimitri Speck's analysis pretty much proved it had been in place for a decade. By then, J.P. Morgan and American Barrick, I think it was 2002, had already admitted in court that they should be immune to prosecution because they were suppressing gold prices merely as, quote, agents of the government. And in a June 2005 speech, the BIS's then head of its monetary and economic department, William White, claimed that among the, quote, intermediate objectives of the central bank cooperation, the BIS spearheads, as colloquially the central banker's central bank, one of them was, quote, joint efforts to influence asset prices, especially gold and foreign exchange, in circumstances where this might be thought useful. Such as, for instance, the vicious Operation PM Annihilation II attack of December 8, 2011. Just 2 months after Operation PM Annihilation, one was executed on Labor Day night to take dollar-priced gold down from its all-time high of $1,920 per ounce within hours, I think just 1 hour, of one of the most gold-bullish announcements of our lifetimes, i.e. the ill-fated Swiss National Bank decision to peg the franc to the dying euro, which per what occurred earlier this year, the entire world now realizes was one of the stupidest and most suicidal central bank decisions ever. Heck, just yesterday the Swiss National Bank closed nearly all loopholes to its current negative interest rate policy. So, to Swiss voters that blew the chance to repeg the franc to gold last November, we look forward to increasing the tenor of our "we told you so" views in the coming years. Anyhow, on December 8, 2011, the ECB announced yet another surprise rate cut in response to its collapsing economy, en route to the negative rates that it too enjoys today. Gold surged to $1,755 an ounce in the aftermath of the 7:45 a.m. Eastern Standard Time announcement, and clearly looked ready to recoup all its Operation PM Annihilation I losses from just 3 months earlier. And thus, at exactly the 8:20 COMEX Open, when the cartel's full paper-naked shorting abilities were behind it, it forever dispelled both the desperation behind its actions and any pretense of the myth of its existence when the following headline was leaked to the world's largest financial media outlets. Quote, market sources report the Bank of International Settlements, Bank of England, and Federal Reserve were selling gold after it popped to session high at GMT 1335. Gold subsequently plunged from 1755 to 1715 in the ensuing 5 minutes before closing at 1705 en route to its low close of the year, not surprisingly on New Year's Eve, at $15.20 per ounce. While silver peaked at $33.25 per ounce at the time of the headline, falling all the way to $26.25 by year end. By the way, those headlines were quietly retracted a few days later, but never denied. And of course, neither the Fed nor the Bank of England ever reduced their official amount of gold holdings, proving that either the headline was a lie or, equally likely, the gold reserve accounting is fraudulent. In hindsight, these fearful, desperate actions weren't even the last of the post-2011 precious metal high suppression efforts, as 2012's leap day violation was necessitated when gold had actually risen back to $17.90 per ounce. And of course, the event that launched the financial concentration camp real money believers are currently being held in, the April 11, 2013 closed-door meeting between Obama and the so-called too-big-to-fail bank CEOs, preceding the following day's alternative currency destruction raids. Today, whilst the cartel's raids are far more orchestrated, care of a planning scheme that no longer occurs as needed but on a 24/7 basis, their footprints are larger than ever, such as the BIS's own annual report in which it claims to transact foreign exchange and gold on behalf of its customers, i.e. other central banks, to enable the, quote, regular rebalancing of reserve portfolios or major changes in reserve currency allocations. Of course, given that the IMF rules governing gold accounting allow said central banks to double count leased and swapped gold, none of these BIS transactions, including those of December 8, 2011, ever cause central bank reserve holdings to change one iota. Moreover, despite record physical demand and unequivocally what will soon be a widespread expectation of production declines for years to come, gold is now trading at inflation-adjusted levels nearly as low as the 1999 to 2000 bottom, probably lower considering that the inflation numbers are now more rigged than ever, amidst the most psychotic and rapidly expanding episode of currency debauchery in global history. Gee, I wonder how this will turn out. That educational lesson out of the way, let's get back to some of the 8 pages of horrible headlines depicted in today's title. That is, after listing, in one bronchiated breath, the various manipulation operations going on as I speak. 1. Whilst comically a single trader, Indian I might add, was charged with a role in the 2010 flash crash that was clearly the product of government and Wall Street algorithms run wild, and decidedly not one rogue trader. Zero Hedge graphically showed how exactly the same thing, the so-called trade spoofing he was accused of, occurred yesterday. Perhaps if Zero Hedge could point out the dead ringer and Hail Mary algorithms propping up the Dow Jones propaganda average each day, it would be of benefit to the countless millions of global stock market watchers as well. 2. Zero Hedge also noted the, quote, mysterious treasury bond seller that has been showing up like clockwork at 8 a.m. Eastern Standard Time each day for the past month, just as the mysterious crude oil futures buyer, i.e. the oil PPT I've been writing up for the past 2 months, has emerged in equally blatant fashion. Regarding the latter, don't be surprised if it is actually regarding the former, I should say, don't be surprised if it is actually one or more sovereign nations, particularly the Chinese, who in recent Treasury International Capital reports have considerably reduced Treasury holdings, likely as they simultaneously purchase additional gold. And as for oil prices, which relentlessly rise in spite of the worst imaginable news flow, such as yesterday alone, surging inventories, record Saudi production, and an end to Saudi Yemeni bombings. Let's just say the U.S. government is as painfully aware of the catastrophic impact of plunging oil prices on the U.S. economy as they are of surging gold and silver prices. Of course, the irony of it all is that Janet Yellen considers falling gasoline prices a, quote, net positive for the economy. And now that they are rising anew, with all manner of economic data as bad as it can be, what will she possibly have to say at this coming Wednesday's FOMC meeting? And by the way, if in fact the Chinese do intend to dramatically increase U.S. Treasury bond sales into a U.S. economy on the precipice of official recession, with more than a third of all employed workers having less than $1,000 of savings, and the National Association of Credit Managers Credit Management Index down to 2008 crisis lows, all I can say is this, to a QE4, here we come. And how about this unreported story, which you can read about in Jason Furman Gets the NFP Report the night before the official release. Does anyone else? Yes, said Jason Furman, Obama's chief economist, admitted to Bloomberg receiving the NFP employment report, probably multiple times, and handing it to the president himself the night before it is officially published each month. And this, despite a PBS interview with a top BLS executive a year ago, which you can watch in the aforementioned link, claiming how all in-the-know personnel are quarantined from the time the data is completed the day before until it is released the first Friday morning of each month at 8:30 a.m. Eastern Standard Time. 4. Frankly, I'm not even going to go into detail at the disgust I have in watching the blatant support of yet another commodity clearly deemed a national security issue, i.e. Dr. Copper, or as they put it in a report last year, Dr. Death. Copper is widely understood to be one of the world's most industrially sensitive commodities, and given the objectively measured collapse in global activity, the fact that its decline, whilst powerful, hasn't been more so is beyond me. All around it, base metals from nickel to aluminum are in free fall, whilst other building material staples like iron ore and lumber are as well. Yet the same mysterious forces seem to constantly avail themselves over copper, which over the years has been several times suspected of having been cornered by none other than J.P. Morgan. In the past 6 months alone, LBMA copper inventories have more than doubled, whilst the greatest source of copper demand, China, is in an economic meltdown. Let's see how long said forces can keep copper from falling to the low $2 per pound range, which it appears destined to reach at a minimum. Next, let's move on to everyone's favorite topic, Greece, which ironically just 1 year ago issued its first 5-year bond since 2009 to a rousing 8 times oversubscribed ovation. Yes, more so than even Facebook was oversubscribed. Today, with the 2015 Grexit all but guaranteed, the only questions remain: how and when, and how on earth the powers that be could possibly expect to manage, let alone contain, its horrific ramifications. Tomorrow's Eurogroup meeting on the topic will probably be yet another decided failure, particularly in light of yesterday's news that the ECB plans to haircut all Greek bank collateral, rightfully so, by up to 50%. With massive bailout principal payments due next month, hoping and praying for a temporary reprieve from Russia is hardly a positive strategy, and in fact, a so-called Russian bailout, if it ever occurred, could be the worst possible scenario for Europe's banking elite. In my mind, the bigger question is whether Alexis Tsipras's Syriza party can retain power unless it defaults now. And of course, will the far more stabilizing Golden Dawn neo-Nazi party take power? And of course, how long will it take before Spain's Podemos, France's National Front, Italy's Five Star Movement, and other radical anti-austerity movements do the exact same thing? Ultimately, the euro is a goner, and if we're not here speaking of the new lira, franc, peseta, and drachma 2 years from now, I'll be shocked. Then there's the Far East, where moronic governments haven't figured out how to properly create a speculative bubble, as the more experienced market manipulators in the West have. In Japan, yesterday's news that imports collapsed by an astounding 15% in March, in the biggest monthly collapse in 6 years, prompted the Bank of Japan-owned Nikkei to close at its highest level since the peak of the 2000 internet mania. Better yet, in perhaps the most damning validation of the QE to infinity forecast we have given for years, a former Bank of Japan official officially had the cojones to claim an end to Abenomics was, quote, out of the question. In China, this morning's PMI manufacturing report, at a highly contractionary 49.2, was not only well below expectations, but at the lowest level in a year. Chinese stocks, of course, surged further on expectations of more PBOC easing, which I assure you they'll get in spades, particularly when the PBOC decides China's collapsing exports can only be saved by depegging the yuan from the dollar and letting it plunge as it rightfully should. The Chinese and Hong Kong stock markets are now in all-out, massively margined, late 1999 mode, amidst the worst economic outlook in modern Chinese history, which is why, with each passing day, it becomes more and more clear that the Chinese need to disclose how much gold they have actually acquired. As when the collapsing Chinese economy meets head-on with the hyperinflation the PBOC is inadvertently creating, only global knowledge of the nation's massive gold holdings will be able to save it. In Europe, this morning's massive miss in the composite, i.e. Service Plus Manufacturing Index, puts to rest any ridiculous notion of recovery with an exclamation point, notwithstanding Mario Draghi's propagandist lies. Basically, April business activity in Europe fell across the board, as apparently a collapsing euro is no better for Europe as a collapsing yen is for Japan. Hence, the fallacy of the global currency wars, which serve only the politicians that claim they are engaging in them to obtain jobs, but not the 99% that never receive them. Then again, our leaders claim bombing the Middle East is a boon for regional democracy, as opposed to what has actually happened in Iraq, Afghanistan, Syria, Libya, and everywhere else our bombs and boots have touched. Just yesterday, the all-telling Euribor interest rate turned negative as well, indicating European banks now must pay each other to borrow, as European lending activity has gotten so weak. Moreover, multinational companies have been reporting absolutely abysmal global revenues, such as Caterpillar, of whose business even Jim Cramer calls, quote, the primer and source of your global outlook, which reported its 28th consecutive month of declining sales, compared to just 19 months during the 2008 to 2009 crisis. Throw in the debilitating impact of the surging dollar on U.S. multinationals' earnings, and you can see why the White House itself complained last month of the headwinds to growth the rising dollar is posing. This is yet another reason why the Fed would be insane to even hint at raising interest rates, let alone to actually attempt to do it. And the funniest part of all is that not only would a minuscule quarter or half-point rate increase not be enough to would be enough to cause a dollar explosion and global inflationary apocalypse, but it would have a massively negative impact on America's ability, federal, municipal, corporate, and individual, to finance history's largest and explosively increasing debt burden. By the way, for those that actually believe the ridiculous headlines yesterday that gold's plunge at exactly the 10 a.m. key attack time, no less, was due to, quote, strong home sales numbers, please spare me. Aside from the fact that home sales of all types are light years from the 2007 highs and barely off the 2012 lows, yesterday's existing home sales number was lower than both the year and 2 years ago figures and barely better than expectations. Meanwhile, 90% of all economic data has been far worse than expectations for months now, but gold is capped every time, including this morning when not only were Chinese, Japanese, and European data all well below expectations, but US data was 4 for 4 in the big miss category. Amazingly, yesterday's existing home sales increase for March occurred despite the so-called bad weather that is being blamed for the aforementioned 90% of misses, which, by the way, constitutes not only the biggest cumulative negative economic surprise reading since the 2008 crisis, but is far bigger than last year's supposed polar vortex readings. In fact, not only has this year's weather been far better than last year, but it's actually better than average. And moreover, we're talking about March now, not January, when spring starts. The fact, of course, is that the economy stunk horribly last year and is even worse this year. So much so that even the government's omnipresent seasonal adjustments aren't large enough to offset it. And the funniest part about yesterday's existing home sales increase was that not a peep came from Wall Street or the MSM about bad weather, let alone as the report, which will likely be downwardly revised anyway, as it usually is, showed the Midwest to have the strongest growth. Yes, the Midwest, where the so-called bad weather was supposedly the worst. Anyhow, this morning alone, jobless claims unexpectedly exceeded last week's elevated level, recovering job market and all. Oh wait, that is if you don't include last month's horrific NFP report. Whilst the Bloomberg Consumer Confidence Index plunged, the PMI Manufacturing Index unexpectedly declined from 55.3 to 54.2 compared to a forecast increase to 56.0. And drumroll please, new home sales not only failed to validate yesterday's existing home sales increase, but did so in spectacular fashion. Yes, just 24 hours after the housing market was propagandized to be fixed based on slightly higher sales in the spring than the winter. New home sales plunged from 539,000 in March to 481,000 in April, well below expectations of 518,000 and the largest monthly plunge in 2 years. Gold, of course, has been capped all morning. And as I write, its modest gains haven't yet offset yesterday's big losses. And I certainly don't see any headlines that gold is up due to weak home sales. Before I go for a well-deserved weekend of rest, I have 2 more things I wanted to point out. For one, everyone should read Bill Holter and my rebuttals to Harry Dent's latest deflationary scare. Bill's is titled Dangerously Dented Logic, while mine is titled The Deflation Boogeyman, with some follow-up commentary in today's one chart that says it all. In the past year of massive precious metal price suppression, real money advocates have witnessed the newsletter writing community at its best and worst, and in our view, this is the worst of the worst. And last but not least, I highly recommend you listen to the special interview I conducted yesterday with Miles Franklin's president, Andy Schekman, titled Swaps, Trades, and Repatriations. In it, we go into great detail regarding the myriad precious metal portfolio optimization strategies we can assist you with, whilst availing you of myriad warnings regarding the dangers of doing so for the wrong reasons, with the wrong facilitators, or at exorbitantly high costs. This interview is posted on the Miles Franklin blog, and I guarantee it will be worth your time. To that end, if you are considering the purchase or storage or sale of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thank you.